Get your free copy of the complete tutorial at www.teachucomp.com/free. As stated in previous lessons, one of management's major functions is to control company operations. The use of budgets to control operations is essential in financial health. There are two types of budgets to be aware of: static and flexible. When used in budgetary control, each budget included in the master budget is considered to be static. A static budget is a projection of budget data at one activity level. These types of reports will not show data for different levels of activity. Companies use these to compare actual results with budget data at the activity level that was used in developing the master budget. Let's take a look at an example. This shows XYZ Inc.'s budget and actual sales data for the different quarters. Notice the row at the bottom that shows the difference between the budgeted and actual sales amounts. The sales budget report's first quarter is shown here. This is just for the product line for mini softball bats. In a real static budget, the company would show all of the different product lines and the differences between the budgeted and actual sales amounts. Also notice that there is a U in the difference column. U stands for an unfavorable variance, while F stands for favorable. This variance is unfavorable because our actual sales data is $1,000 less than our budgeted. In contrast to a static budget, which is based on one level of activity, a flexible budget projects data for various levels of activity. In essence, the flexible budget is a series of static budgets at different levels of activity. In our example, we have a manufacturing overhead budget that is static. If we wanted to make this budget flexible, we would show different levels of activity. To develop a flexible budget, management takes certain steps. They first identify the activity index and the relevant range of activity. Next, they identify the variable costs and determine the budgeted variable cost per unit. Third, they identify the fixed costs and determine the budgeted amount for each cost. And finally, they prepare the budget for selected increments of activity within the relevant range. In order to find total budgeted costs at any level of activity, management takes fixed costs and adds variable costs to determine the total budgeted costs. Overall, static and flexible budgets are very important tools for managers when it comes to controlling operations. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.